Hi, this is Randy Kramer with the Red Oak Real Estate Group, and today I'd like to talk to you about short selling in today's real estate market. There are a lot of great deals out there available for buyers in today's market with the epidemic of foreclosures and that situation. Short selling, I'm going to define for you today, and I'm going to talk about some of the benefits and some of the downsides to negotiating a short sale as a buyer and as a seller. So let's get started. First of all, the definition of short selling: selling a residential property for less than is currently owed on the mortgage with the agreement of the lender. So basically, if you've got a situation where an owner is unable to keep their home, they can't pay their mortgage, and say for instance they don't have any equity or little equity, and the house is not worth what they paid for it, they're going to have to negotiate with their bank, with their lender, to allow them to sell their house for less than what is owed on it. That's what a short sale is. Some key points here: short selling can benefit the seller, the lender, the buyer, and the community. There are possible financial impacts to the seller that should be negotiated, understood, and clearly documented. Short sale properties can provide great values for buyers. And while short sales are more common these days, the advice of an experienced realtor is essential. You don't want to try and do this on your own. You really need to get a real estate agent involved in the process. From the seller's perspective, the benefits in short selling are, the biggest one is they're able to get out from under a mortgage that they cannot pay. They don't have to typically declare bankruptcy. The drawbacks to short selling drastically affects credit history. The lender has to approve any short sale, and this can lengthen the sales cycle. The lender may ask for cash or a note, a promissory note, in addition to the proceeds of the short sale, and the seller may be taxed on the amount of debt forgiven. Basically, again, the benefit, with the market being what it is right now, a lot of sellers are in this predicament where they owe more than their house is worth. And if they can't afford to stay there, they don't really have a choice other than to give the house back to the lender. This is going to make the situation much easier for that seller if they're able to sell it versus give it back. It helps with the credit situation a great deal, and it eliminates a lot of potential problems for that seller down the road. It will affect their credit history. There's no way to eliminate that from happening. And the process is timely. A lot of times you've got negotiators involved with the bank. You've got investors involved sometimes with the bank. And each one of these players that's involved in the process can tend to lengthen the sale process. The lender's perspective, the benefits to a lender are the lender does not have to go through the process of an eviction and a foreclosure. They work directly with the seller, meaning the house is going to be left in better condition. And the one major drawback is the lender is going to accept less money than they are owed under the terms of the mortgage. However, it's probably going to be a better situation for the lender than if they were to take the house back and have to basically prepare the house to resell it. And when they put it back on the market, once it's vacant, they have to pay a property management company to manage the house, in addition to probably listing the house for resale at less than what they had it on the market for initially with the short sale. From the buyer's perspective, the benefits of properties may be available for less than assessed value. Buyers have more properties on the market to choose from. The drawbacks for a buyer: if the mortgage was not affordable for the previous owner, maintenance may not have been kept up, meaning if you couldn't afford to pay your mortgage payment, you probably couldn't afford to have the furnace looked at. So if you're interested in buying one of these, an inspection would definitely be, in my words, mandated. Although you don't mandate inspections, but in a situation like this, an inspection would be a very good investment of a few $100s for peace of mind. The other drawback for a buyer in this case: the process of buying a house may take slightly longer, since one or more parties, the seller's lender and the lender investor, must approve any financial terms, which I had discussed previously. Typically, a short sale can be negotiated within 30 to 45 days. And then in addition, you've got the normal mortgage approval process. So you're generally typically looking anywhere from 30 to 90 days to get the process started and finished. A normal transaction, and when I say normal, I mean something outside of a short sale, usually would take anywhere from 30 to 45 days max, start to finish. So you're almost doubling the time potentially to initiate and close a short sale transaction. The community's perspective of short sales, the big benefit is they don't have foreclosures in their neighborhood, which totally dilute property values. That is a big benefit because a short sale is better than a foreclosure. The big drawback is the house may still be left unoccupied if the house does not sell by the date the current owner must leave. So there is a chance that the lender will work out an arrangement with the seller. Normally they want the seller to stay in the house to take care of it because the lender knows the house is worth more while it's occupied than when it's not. But there are times when the sellers leave the house, basically abandon the house, and even on a short sale, and that's not a good situation for the neighborhood because the house is just left there to sit, and nobody's really able to take care of it unless the lender gets involved in that, and a lot of times the lender doesn't want to have to take care of it.